There is an edge in trading that is so reliable, so consistent, and so powerful that if you had it, your results would transform within months. And I can tell you with absolute certainty that you do not have it right now. Not because it is rare, not because it is complicated, but because you have never been told it exists, and even if someone had told you, you would have dismissed it. Because it has nothing to do with your win rate, your strategy, your indicators, or any setup you have ever studied. The edge is a number, a single metric that you have never once measured in your entire trading career. And that metric is your consistency score, the percentage of trades on which you followed every rule of your own plan without a single deviation. I want you to guess what your number is right now. Not what you hope it is, not what it feels like it should be, what it actually is. Most traders, when they first measure this honestly, discover they are somewhere around 50 to 60%. That means on nearly half of their trades, they are doing something entering early, widening a stop, oversizing a position, skipping a valid setup that their own plan specifically prohibits. They are running a corrupted version of their strategy on almost half their trades and then blaming the strategy for not working. Mark Douglas recognized this pattern at the very foundation of his work with struggling traders. The traders who came to him almost never had a strategy problem. They had strategies that worked, verified, back-tested, statistically sound. What they did not have was the ability to execute those strategies consistently under live conditions. The gap between what they planned and what they actually did was not a minor discrepancy. It was the single largest source of losses in their accounts, larger than bad setups, larger than poor timing, larger than adverse market conditions. The execution gap was where the money went. That gap is where your money goes too. And today, I am going to show you how to close it to 10% or less, how to build a 90% consistency score that functions as the most powerful edge you have ever possessed. If you are the kind of trader who actually wants to see this gap, who wants to track not just profit and loss, but the beliefs, emotional states, and decision patterns that drive your execution failures, that is exactly the kind of structured self-observation that the Speculator's Journal was designed for. It makes visible what Mark Douglas could only ask traders to discover through willpower and brutal self-honesty. The link is in the description. But first, let me show you what you have been missing. Let me start by showing you what the execution gap actually looks like in your trading, because I do not think you realize how pervasive it is. You have a rule that says you enter only when price reaches a specific zone, but the candle is accelerating and your brain tells you it is going to leave without you, so you enter 3 candles early. You just broke your rule. You have a rule that says your stop goes at a specific technical level. But the trade moves against you and the stop is about to be hit, and you move it 10 pips further away because you are not ready for the loss. You just broke your rule. You have a rule that says you risk 1% of your account per trade. But this setup looks exceptional. High confluence, clean structure, everything lined up so you risk 2.5% because this one is different. You just broke your rule. You have a rule that says you take every valid setup that meets your criteria, but you lost on the last 2 trades and this one feels risky, so you skip it. The trade runs 100 pips without you. You just broke your rule, and now the frustration of missing it will drive you to force a trade on the next mediocre setup, you see. You have a rule that says you hold to target, but the trade is up 40 pips and you can feel the profit slipping away, so you close it at half target. It continues to your original target and beyond. You just broke your rule. How many of those did you recognize? My guess is all of them. And here is the part that should concern you. Each one, by itself, seems minor. A slightly early entry, a slightly wider stop, a little extra risk, 1 skipped trade, 1 early exit. Individually, they feel like small adjustments, not catastrophic errors. But they are not individual events. They are a pattern. And the pattern compounds over 20 trades, over 50 trades, over a month. Those small deviations destroy the statistical edge your strategy was designed to produce. You take a system with a genuine, proven, positive expectancy and you corrupt it trade by trade, deviation by deviation, until the output has no resemblance to the backtest. And then you conclude that the strategy is broken and you go looking for a new one. But the strategy was never broken. Your execution of it was. Mark Douglas described working with traders who went through this cycle repeatedly: build a strategy, test it, prove it works, trade it live, break their own rules, lose money, discard the strategy, find a new one, repeat. Over and over. Some of them had discarded 6, 8, 10 strategies that actually had verified edges simply because they could not execute any of them consistently enough to let the edge express itself. The problem was never the system. The problem was the operator. And the operator could not see it because they were only measuring the one metric that confirmed their narrative profit and loss instead of the metric that would have revealed the truth. I know what you are thinking. You are thinking, I know I break my rules sometimes, but my real problem is my strategy. If I had a better system, the results would follow. That is the most expensive lie in trading. And I need you to hear this clearly. You do not need a better strategy. You need to actually execute the one you have. The search for a better system is itself a symptom of the execution gap. It is what you do instead of confronting the uncomfortable truth that you already have something that works and you keep sabotaging it. Now, let me reframe everything you think you know about what an edge actually is. Here's the lie the trading industry has sold you, implicitly or explicitly, for years. The lie is that an edge is a strategy, an entry trigger, a proprietary indicator, a pattern that wins 60 or 70 or 80% of the time, something external, something you discover in the data, in the charts, in the market structure. And that once you find it, profitability is the inevitable result. This is a half-truth, which makes it more dangerous than an outright lie. Yes, you need a strategy with a statistical advantage. That is a necessary condition, but it is nowhere close to sufficient. Because a strategy only produces its statistical advantage when it is executed consistently. An edge that you follow on 60% of your trades is not an edge. It is a suggestion. The math only works when the inputs match the model. Deviate on 40% of the inputs, and the expected output becomes meaningless. You are no longer running the system. You are running noise. Here is the truth that Mark Douglas built his entire career around, articulated more clearly than anyone before or since. The real edge is not your strategy. The real edge is the alignment between your plan and your behavior, sustained over a statistically meaningful number of trades. A mediocre strategy executed at 95% consistency will outperform a brilliant strategy executed at 60% consistency every time, over any meaningful sample. This is not a motivational statement. This is mathematics. And the math does not negotiate. That is the 90% edge, not a 90% win rate, a 90% execution rate. The percentage of trades where you do exactly what your plan says, no deviations, no improvisations, no exceptions, get that number above 90 and hold it there. And you will have an edge that most traders will never discover. Not because it is hidden, because they are too busy searching for the next indicator to look at the only metric that actually predicts profitability. Let me show you exactly how to build it. 5 practices, each one closes a piece of the gap. Let me talk about the first practice, the consistency score. This is non-negotiable. At the end of every trading day, you review each trade you took and you answer one question about each one. Did I follow every single rule of my plan on this trade? Yes or no? There is no partial credit. There is no mostly. If you followed 5 rules and broke the 6th, the answer is no. Then you calculate the percentage. 4 trades today. 3 were fully plan compliant. 1 was not. Your consistency score for the day is 75%. You track this number daily. You calculate it weekly. You calculate it monthly. And your singular goal for the next 6 months is to get this number above 90 and keep it there. Here is the psychology. Measurement changes behavior. This is one of the most well-documented phenomena in behavioral science. The act of tracking a behavior increases the probability of performing that behavior correctly. Simply knowing that you will have to write down at the end of the day whether you followed your rules makes you more likely to follow them in real time. You are adding accountability to a process that currently has none. Right now, your rule breaking disappears into the fog of the trading day, unrecorded and unexamined. The consistency score makes it visible. And once it is visible, you can no longer ignore it. I know what you are thinking. You are thinking that a binary yes or no for each trade is too harsh, that mostly following your rules should count for something, but it does not. And here is why. Mostly following is how you trade right now. And right now, you are not consistently profitable. The distance between mostly and completely is not a rounding error. It is the gap where your profits leak out, trade after trade, day after day. Every exception you allow, every close enough, every just this once, is a crack in the container. And you cannot fill a container that has cracks in it, no matter how much water you pour in. Let me give you a worked example. You trade 4 days this week. Monday, 3 trades, all plan compliant. Score, 100%. Tuesday, 2 trades, 1 broke the early entry rule. Score, 50%. Wednesday, 4 trades, 3 compliant, 1 had an oversized position. Score, 75%. Thursday, 3 trades, all compliant. Score, 100%. Weekly average, 81.25%. That is your real edge metric. That number tells you more about your future profitability than your win rate, your P&L, or any indicator on your chart. And until today, you had never calculated it. Let me talk about the second practice, the 20 trade proof. This is non-negotiable. You commit right now, today, to executing your next 20 trades with 100% rule adherence. Not 90%, not as close as possible, 100%, every rule, every trade, no deviations. 20 times. Here is the psychology. 20 trades is large enough to produce statistically meaningful data, but small enough to feel achievable. You are not committing to a lifetime of perfection. You are committing to 20 trades. That is all. And during those 20 trades, you are forbidden from evaluating whether your strategy works. You are forbidden from tinkering with parameters, adding indicators, changing rules, or switching to a different system. You execute 20 times. Then and only then you evaluate the results. This accomplishes something critical. It separates the strategy question from the execution question. Right now, you cannot tell which one is the problem because you have never isolated the variables. When you lose money, you do not know if you lost because the strategy lacks an edge or because you broke your rules. Those are 2 completely different diagnoses requiring 2 completely different treatments. And you have been guessing between them, usually choosing broken strategy, because that is the diagnosis that does not require you to examine your own behavior. The 20 trade proof eliminates the guesswork. If you execute 20 trades with perfect adherence and the strategy produces a positive expectancy, which, in my experience, happens the vast majority of the time, then you have proven to yourself that the strategy works. The problem was always execution, and now you know. Not because someone told you, because you proved it with your own data. That kind of proof changes you in a way that no video, no book, and no mentor ever can. It is experiential knowledge. And experiential knowledge is the only knowledge that survives contact with live markets. I know what you are thinking. You are thinking, what if I execute perfectly and still lose money? Then you have something invaluable. You have clean data, uncontaminated data that tells you your strategy does not have the edge you thought it had, and you need to modify it or replace it. That is not a failure. That is the most useful information you have ever generated. Because right now, you are trading a strategy whose real performance is unknown to you. You think you know how it performs, but every data point is contaminated by execution errors. You are making career decisions, stay with this strategy or leave. Risk real money or stop based on data that has been corrupted by your own behavior. The 20 trade proof gives you the truth. Whatever that truth is, it is better than the uncertainty you are currently living with. Let me give you a worked example. You start on a Monday, trade 1 valid setup, standard size, proper stop, held to target, compliant. Trade 2 valid setup, entered slightly early because the candle looked like it was breaking out, not compliant. You stop, you reset the count. Trade 1 again, this is important. The count resets on the first deviation. You do not get to carry over 4 compliant trades and then add one non-compliant trade and call it 80%. The commitment is 20 consecutive compliant trades. The reset is what creates the psychological pressure that changes the behavior. Because by trade 15, you will be so invested in the streak that you will pause before breaking a rule. You will feel the weight of the count, and that weight, not willpower, not discipline, but the structure of the commitment itself will keep you on plan. Let me talk about the third practice, the belief excavation. This is non-negotiable. Every time you break a rule, every single time you conduct a brief written investigation, not a vague reflection, a specific two-part inquiry. Part one, which rule exactly did I break? Not I was undisciplined. Which rule? Name it in concrete terms. I entered before price reached my zone. I increased my position size to 2%. I moved my stop 12 pips further from entry. Specificity matters because vague diagnoses produce vague fixes. Be more disciplined is not a fix. Stop entering before price reaches my defined zone is a fix. Part two, what did I believe in that specific moment that made breaking the rules seem like the right decision? This is the question that goes beneath the behavior to the source code. You broke the rule because, in that moment, you believed something that overrode your plan. You believed the trade was going to run away without you. You believed this setup was special and justified extra risk. You believed the stop was about to be hit and the trade would reverse if you gave it more room. These beliefs are not random, they are persistent, they recur, and they are the machinery that produces your inconsistency. Here is the psychology. You do not break rules because you are undisciplined. You break rules because you hold beliefs that, in specific market moments, generate behaviors that contradict your plan. Those beliefs operate below conscious awareness. You are not thinking, I believe this trade is going to run away. You are thinking, I need to get in now. The urgency feels like market reality, not like a personal belief. But it is a belief, and until you name it and see it for what it is, it will keep driving the same behavior. I know what you are thinking. You are thinking this is too psychological, that you just need to be tougher, not introspective. But toughness without awareness is just a louder version of the same pattern. You will break the rule with more frustration afterward, but you will still break it. The excavation gives you something toughness never can: recognition. After you have written down, I believed the trade was going to run away without me 10 times across 10 different trades, something shifts. The 11th time that belief fires, you catch it in real time. Before you act, you feel the urgency rising and you think, I know this one. This is the runaway belief. I have documentation showing it leads to early entries that underperform. I do not follow this belief. I follow my plan. That is not toughness. That is awareness. And awareness, unlike toughness, does not deplete under stress. Think of it like debugging code. You do not fix a bug by running the program harder. You fix it by tracing the logic to the exact line where the error occurs and rewriting that line. The belief excavation traces your execution failures to the exact belief where the error originates. Once you see the line, you can rewrite it, but you have to look at the code first. Let me give you a worked example. End of Tuesday. You review your trades. Trade 2 broke a rule. You entered EUR, USD, 3 candles before price reached your zone. Part 1. I broke my zone entry rule. I entered at 1.084 instead of waiting for 1.0825. Part 2. What did I believe? I believed the candle was accelerating and price was not going to reach my zone. I believed if I did not enter now, I would miss the move entirely. You write it down, you read it, then you check, did price reach the zone? You look at the chart. Yes. Price reached 1.0822 45 minutes later and then rallied to the target. Your belief was wrong. And not just wrong, this time you check your log and find that you have written some variation of I believed price was going to leave without me on 8 of your last 12 rule breaks. That is not a random error. That is a recurring belief that is costing you money on a systematic basis. Now you can address it. Not with willpower, with evidence. Let me talk about the fourth practice, the morning alignment protocol. This is non-negotiable. Every morning, before the market opens, before you look at a chart, you write down three things. 1. My consistency score target today is 100%. Write it every morning. The act of committing to it in writing before the session starts activates your prefrontal cortex and primes the intention before the emotions of live trading arrive. 2. The rule I am most likely to break today is specific rule, and it will be triggered by specific condition. Be honest. If yesterday was a loss day, you might be tempted to oversize. If you have been in a drawdown, you might be tempted to skip valid trades. If you had a big win, you might be tempted to get careless. Name the specific rule. Name the specific trigger. 3. When I am tempted to break that rule, I will specific action. Write the behavioral response. I will pause for 10 seconds, reread my plan, and confirm every criterion is met before entering. Not a vague intention, a specific, concrete action tied to a specific, anticipated trigger. Here is the psychology. This is not journaling for the sake of journaling. This is a pre-commitment device. Research in behavioral psychology shows that people who write down a specific intention, including the trigger and the planned response, are dramatically more likely to follow through than people who set a general goal. I will be disciplined today is a general goal. When I see price accelerating before reaching my zone, I will close my laptop for 60 seconds and return only when the zone is reached is a specific implementation intention. The first one dissolves the moment stress arrives. The second one has a trigger, a response, and a mechanism. It survives stress because it does not require you to generate a plan in the moment the plan was already generated. This morning, when you were thinking clearly, I know what you are thinking. You are thinking this takes too long, that you do not have time for a morning writing exercise before the session starts. But let me ask you this. How much money did you lose last month on trades that broke your own rules? Add it up. Now tell me that 3 minutes of writing every morning is too expensive. You are spending thousands of dollars on execution errors and refusing to invest 3 minutes in preventing them. That is not efficiency. That is avoidance. And avoidance, as Mark Douglas spent decades demonstrating, is the behavior that keeps traders trapped in cycles they cannot escape. Let me give you a worked example. Tuesday morning, you sit down at 7 o'clock. You write, consistency target, 100%. Rule most likely to break. Zone entry rule. I tend to enter early when the candle accelerates. Trigger. Fast-moving candles approaching my zone. Response. When I see price accelerating, I will close the order window, set a price alert at my zone, and not reopen the window until the alert triggers. You close the notebook, you open your charts. And at 9:45, when your USD starts dropping fast toward your zone, and every instinct in your body is screaming to enter now before it reverses, you remember what you wrote. You set the alert, you close the window, the alert triggers at your zone, you enter on your terms, and your consistency score for that trade is a yes. That 3-minute exercise just saved you from repeating the single most frequent execution error in your log. Not through willpower, through preparation. Now let me talk about the deeper shift underneath all of this, because the practices I have given you are the mechanism, but the transformation is about something larger. You need to redefine what the word edge means to you. And this is not a semantic exercise. This is the paradigm shift that determines whether you spend the rest of your trading career searching for something that was always right in front of you. Right now, you believe that edge equals strategy. You believe that profitability comes from finding the right system, the right indicators, the right confluence, the right win rate, and you believe that your job as a trader is to search for that system, test it, and deploy it. If it does not work, you search for another one. The entire enterprise is a search for something external, but here is what I need you to understand. The search is the problem, not because good strategies do not exist, they do, but because the search itself is a form of avoidance. Every time you switch to a new strategy, you are escaping the uncomfortable truth that the old strategy probably worked. You just did not execute it consistently enough to prove it. And the new strategy will suffer the same fate, because the variable that determines success is not the strategy, it is you. It is the gap between your plan and your behavior, and you carry that gap with you to every system you try. It follows you like a shadow. You cannot outrun it by switching strategies. You can only close it by measuring it, confronting it, and doing the daily work of eliminating the beliefs that keep prying it open. Think of it this way. You have a restaurant with excellent recipes. The food, when prepared correctly, is outstanding. But the chef keeps improvising. One night he adds extra salt. The next night he changes the cooking time. The night after that he substitutes an ingredient because he thinks he knows better. The customers keep sending dishes back, and the owner keeps blaming the recipes. But the recipes were never the problem. The chef's inability to follow them was the problem. You are the chef. Your strategy is the recipe. And your consistency score is the measure of whether the food that reaches the table matches what the recipe promised. The edge is not the recipe. The edge is the chef who follows the recipe exactly, every time, without improvisation, without ego, without the belief that this particular dish is special enough to justify a deviation. Let me bring everything together. 5 practices. Each one closes a piece of the execution gap that is currently destroying your edge. 1. The consistency score. Binary, trade by trade, calculated daily. Did you follow every rule? Yes or no? Track the percentage. Get it above 90. 2. The 20 trade proof. 20 consecutive compliant trades. No tinkering. No evaluation until the sample is complete. 1 deviation resets the count. 3. The belief excavation. After every broken rule, name the rule and name the belief that made breaking it feel reasonable. Track the recurring beliefs. They are the source code of your inconsistency. 4. The morning alignment protocol. 3 minutes every morning. Consistency target, most likely rule to break. Specific response to the specific trigger. 5. Redefine your edge. Stop searching for a better strategy. Start measuring your execution of the strategy you have. A mediocre system at 95% adherence beats a brilliant system at 60% adherence every time. That is mathematics, not motivation. Do these 5 things every single day for 6 months, not occasionally, not when you remember, every session. And here is what will happen. Your consistency score will climb. It will be ugly at first, maybe 60% the first week, maybe 65 the second. The old beliefs will fight you. The old impulses will fire. The count will reset multiple times before you reach 20. That is fine. That is the process. Because every reset teaches you something. Every broken rule, when excavated, reveals a belief you can now recognize and override next time. And week by week, the score will rise. 70, 75, 80, 85. And somewhere around 85 to 90%, something remarkable will happen. Your P and L will change. Not because you found a new strategy, not because the market got easier, because you stopped corrupting the edge you already had. You stopped pouring clean water into a cracked container. You sealed the cracks, and the container began to fill. The strategy you almost threw away, the one you spent months building and backtesting and then abandoned because it did not work, started working. Because you finally gave it the consistent execution it always required. The strategy never failed you, you failed it, and now you have stopped. That is the 90% edge. It was always there. You were just too busy searching for something more exotic to notice the thing sitting right in front of you, the gap between your plan and your behavior, measured, tracked, and closed. Mark Douglas dedicated his life's work to one single insight, that the traders who achieve lasting consistency do not do so because they find a superior strategy, but because they build a relationship with uncertainty that allows them to execute any reasonable strategy without internal resistance. That relationship is what the consistency score measures. That relationship is